Are you a real estate investor or just a worried U.S. national? Perhaps you're considering jumping into the market. Well, hold your horses because superstar Warren Buffett recently made a shocking claim. The real estate market is set to crash. Yes, you read that right. The king of the stock market, who has long avoided real estate investing, is pointing to a perfect storm of factors that will cause the market to collapse. But what exactly are these factors and how will they affect your investments? Stay tuned as we dive deep into the murky waters of the real estate market to decipher what Warren Buffett's claim really means for you. One thing is for sure, this video may just save you from some severe financial losses. According to billionaire investor Warren Buffett, the U.S. real estate market is in for a rough ride. He has issued a warning about a significant storm that's brewing. The root cause of the storm is the whopping $1.4 trillion debt-fueled tsunami that's about to hit the real estate market. As we speak, it's already starting to affect the industry, and there's no telling how deep it'll cut. And before I reveal what Warren Buffett has to say, please take 2 seconds to help me out and hit the like and subscribe if you're enjoying the video so far. Each like and subscribe is fuel for the algorithm that helps support this channel. Thank you. Now, back to what I was saying. Sadly, it's just the beginning of the damage Buffett forecasts from this bursting real estate bubble. The implications concern many investors, stakeholders, and those considering buying property. The debt burden is significant and could have far-reaching implications in the months and years to come for the U.S. real estate market. It's a waiting game filled with uncertainty, and the best advice for investors is to brace for impact and tread carefully. In just a matter of months, we'll begin to witness the true impact of what's been brewing in the commercial real estate market of the United States. Charlie Munger, the wise investor and vice chair of Berkshire Hathaway, recently expressed his concerns about a potential storm that's about to hit the industry. He cautioned that the decline in property prices has resulted in American banks being burdened with a significant number of risky loans. This pressing concern was highlighted in a recent Financial Times article, which demanded answers on the state of commercial real estate and its potential losses. When we dive deeper into the current landscape, we can see that the commercial real estate market is facing a significant downturn as businesses struggle to pay rent and mortgages, resulting in increased loan defaults. This has caused a ripple effect in the banking sector, as banks may be forced to write off these non-performing loans, forcing them to bear huge losses. If we speak of the sector and geographies that are particularly susceptible to this looming crisis, it's the retail and office real estate markets that are at the forefront. With the rise in e-commerce, many retailers have either gone bankrupt or have had to downsize their physical presence, leading to a fall in demand for retail space. Similarly, with the onset of remote working, the demand for office spaces has also dwindled. Looking at all of the facts and figures, the future of the commercial real estate market appears grim. As more businesses struggle to keep their heads above water, the pressure on banks to write off bad loans will increase, leading to more losses and eventually a full-blown crisis. According to Warren Buffett, the country will likely successfully brave through the current challenges. However, he also believes it will come at a significant cost, often resulting in a shifting ownership of the buildings and properties. It's worth noting that while the physical structures might remain the same, different people might end up owning them. Over the past 15 years, the real estate market in the United States has experienced an unprecedented surge, thanks to the availability of cheap debt. With interest rates at or near 0%, property investors have been able to borrow massive amounts of money, driving up real estate prices to levels that can only be described as astronomical. This isn't just conjecture, it's a fact that cheap debt has been incentivized, leading to an explosion in demand for property investment and development. It's important to understand that this trend cannot go on forever. Eventually, the bubble will burst and the market will correct itself. When that happens, the consequences could be severe for those who have over-leveraged themselves with cheap debt. On the other hand, those who are better prepared might be able to weather the storm and come out ahead. Real estate is a popular investment choice for many people. When it comes to financing these transactions, non-recourse loans are often preferred. The concept of non-recourse financing basically means that the lender cannot come after the borrower's assets if the borrower defaults on the loan. This is seen as a less risky option for borrowers. Most people who become successful in real estate tend to have this frame of mind when financing their properties. They leverage their borrowing power to get the best deals and maximize profits. This is the norm in this industry, and understanding this can help aspiring real estate investors. In commercial real estate development, there's a common practice known as extend and pretend. Those in the industry often witness that. Simply put, it's when lenders hold on to properties as sole owners after an owner cannot repay the debts associated with the property. As you can imagine, lenders don't want to be in this position as they're not in the business of property management. This is where real estate operators come into the picture. They negotiate with lenders to take over the property and become the new owner. The goal for the lender in this situation is to recoup as much of the loan as possible. Often, the real estate operator can offer a more financially beneficial solution than continuing to hold on to the property. This isn't the only activity that arises from commercial real estate development. There are many factors to consider, and the consequences can be substantial. From zoning regulations to property taxes, a lot goes into making these types of transactions work. But when done correctly, it can result in significant gains for all parties involved. Warren Buffett asserts that we are currently observing the outcomes of individuals who have been able to borrow money at exceptionally low rates of 2.5%. As these individuals recognize that their financial plans are not unfolding as expected, given the prevailing rates, they're opting to return the funds to the lender who initially provided the necessary capital for their project construction. But what about those who borrow money to purchase their dream home? Well, it's important to understand that when you take out a loan for a home, you must sign a personal guarantee. This means that even if your home's value depreciates drastically or unforeseen circumstances like natural disasters occur, you are still obligated to repay the lending institution. In other words, when you borrow a large sum of money, it's essential to understand the gravity of the responsibility that comes with it. Regarding commercial real estate, the game is played quite differently than in other markets. Unlike some other forms of investment, where rules are largely consistent, commercial real estate engagement rules vary. In fact, they vary widely depending on the size of the property being purchased. Large commercial properties, such as office buildings, apartment complexes, and warehouses, are typically acquired using a financial method known as non-recourse debt. This means that the borrower is not personally liable for the loan repayment. Rather, the lender's sole recourse is the property itself. Suppose the borrower defaults on a loan. The lender has the right to seize the property, but cannot go after the borrower's personal assets. This type of financing is prevalent in the commercial real estate industry because it allows investors to acquire large properties without the same level of personal risk involved in traditional forms of lending. The American banking industry is a complex web of large and small banks. Still, contrary to popular belief, the small regional and community banks shoulder the majority of commercial real estate loans. This is despite the combined assets of the country's 6 largest U.S. banks towering at a staggering $14 trillion. However, size does not always equal market dominance, as these smaller banks make an estimated 2/3 of all commercial real estate loans. This means that the impending storm hitting the real estate market won't leave the large Wall Street banks feeling the pain, but rather the small banks on the front line in issuing these loans. They'll be the ones left holding the bag. While it is a fact that large banks dominate the financial industry, the landscape is not static, and smaller banks have been holding their own in the commercial real estate market. So if you're looking to secure a loan for your commercial property, don't discount the lending powers of smaller banks that are often more vested in the success of local businesses. In essence, for those contemplating investments in commercial real estate, it is crucial to grasp the intricacies of the market, including the workings of financing. By gaining this understanding, investors can make more informed decisions and steer clear of potentially expensive mistakes. Knowing the ins and outs of non-recourse debt is just one step in becoming a successful player in the complex game of commercial real estate investing. At the end of the day, it's your responsibility to protect your financial well-being, and that means being cautious and making informed choices. Thanks for watching, and please make sure you subscribe if you enjoyed the video, and be sure to leave a comment below letting me know your thoughts.